Everyone talks about saving money, but very few talk about what happens after you save. What's the point of keeping cash that slowly loses value to inflation? In this video, I'll show you 5 ways to turn your spare money, even $10, $100, or $1,000, into passive income streams that grow quietly while you sleep. Most people think they need a lot to start investing. But the truth is, wealth begins with discipline, not dollars. If you can manage a small amount with intention, that small amount will teach you everything you need to handle bigger numbers later. Think about this. Every week, people spend the price of a meal or a coffee subscription on things that disappear. Food, apps, small habits that bring no return. If you redirected even a fraction of that into an automated system that pays you back, you could be building your freedom one small deposit at a time. In 2026, we live in the era of microinvesting. Apps, fintechs, and digital funds have destroyed the myth that you need thousands to grow wealth. You can start with cents, automate the process, and watch it compound, not just in money, but in confidence. So in this video, you'll learn 5 real ways to make your money work for you, which ones require zero maintenance, and which ones grow faster with small effort, how to choose based on your risk, patience, and lifestyle. And by the end, I'll share a story that proves it's not about luck. It's about building systems that never sleep. Because money doesn't need rest. It only needs direction. So if you've ever thought, I wish I could make more without working more, this video is for you. By the time you finish, you'll understand that passive income isn't a dream, it's a formula. The first and easiest way to turn your spare money into passive income is to stop letting it sleep in a normal bank account. Traditional banks pay you almost nothing, sometimes less than 0.5% a year. That means your safe money is actually losing value to inflation. Now compare that with high-yield savings accounts or automated cash funds. In 2026, many digital banks and fintechs offer returns of 4% to 6% annually. Fully automated, no market risk, and with the same level of security as a regular bank. If you deposit just $500 in a high-yield account at 5% interest, that's $25 a year. Small? Yes, but remember, this is completely passive. And when you add a small monthly contribution, say $50, you activate the power of compound growth. After a few years, the difference becomes massive. Let's take an example. A woman in Texas named Sarah started depositing $50 a month into a Revolut high-yield savings account at 5%. After 3 years, she had $2,013, almost $200 more than she would have saved manually, simply because her money was compounding automatically. The key is consistency, not size. You don't need to predict markets or buy stocks. Just redirect idle cash into accounts that reward patience. And if you want to go one step further, try automated index portfolios, platforms like Betterment, Wealthfront, GBM Plus, or Scalable Capital. These tools invest your money across global markets based on your risk tolerance. You don't pick the stocks, the algorithm does it for you, rebalancing constantly for long-term growth. It's like having a quiet financial assistant that never sleeps. This is how normal people start. They automate small deposits, forget about them, and wake up one day realizing their money's been working harder than they have. So before you chase crypto or day trading, fix the basics. Make your savings productive. It's the foundation of every real investor's journey. If high-yield accounts are your foundation, index funds and ETFs are your elevator. They're how everyday people quietly become rich without gambling or timing the market. Here's the truth. More than 80% of professional traders lose to the market. But investors who simply buy and hold index funds, funds that copy the entire market instead of trying to beat it, usually win. That's why billionaires like Warren Buffett tell their families, if you want to build wealth safely, buy index funds and never sell. So what are they? An index fund is a basket that includes small portions of hundreds or even thousands of companies. If you buy one share in an index fund like the S&P 500, you automatically own pieces of Apple, Microsoft, Google, and hundreds more. The average return over the past 30 years? Around 10% per year, and that's without doing a thing. ETFs, exchange-traded funds, work almost the same way but can be bought or sold anytime, like stocks. Examples: VOO, VTI, or QQQ. Names that show up quietly in the portfolios of people who built wealth slowly and surely. Let's make it real. Imagine you invest $100 per month into an S&P 500 index fund. After 10 years, at an average 10% annual return, you'll have about $19,000, even though you only invested $12,000. That $7,000 difference came from compounding, your money making more money every single day. Platforms like Vanguard, GBM Plus, Fidelity, or Interactive Brokers make this simple. You don't need to be an expert. You just need to start and let time do the heavy lifting. Think of it this way. Every share you buy is a silent employee that never sleeps, never complains, and works 24/7 for you. This is the tool that creates the invisible rich. People who live normal lives, never flaunt luxury, yet retire free because their money grew quietly behind the scenes. So while others chase trends, remember, the boring path is often the most powerful one. Imagine being the bank, but on your own terms. That's what crowd lending allows you to do. Instead of lending money to huge institutions that pay you almost nothing, you lend directly to people or small businesses, and you get the interest. Platforms like Mintos, Bondora, Affluenta, or Peerberry have turned this in one of the fastest growing forms of passive income worldwide. Here's how it works. You deposit a small amount. It can be as little as $10, and that money is split across dozens or even hundreds of small loans. Each borrower pays monthly interest, which goes straight into your account. It's fully automated. You don't call anyone, you don't collect payments, you don't chase people. The platform handles it all. Your job is simply to decide your risk level: conservative, balanced, or aggressive. Let's take an example. Marcos, a teacher in Chile, started with $200 on a platform called Affluenta. He set his account to balanced, meaning he lent small parts of that $200 to over 20 different borrowers. In 1 year, his returns averaged 11%, or about $22 profit, completely passive. After that, he reinvested the earnings, and within 3 years his portfolio had grown to nearly $300 with no additional deposits. That's the magic of reinvestment. But like every investment, crowd lending has risk. Some borrowers might default, which is why diversification matters. Never put all your money into one loan. Spread it. Many platforms even offer buyback guarantees, where the platform itself covers missed payments. It's the perfect bridge between security and performance. You're not gambling, you're financing growth and getting rewarded for it. Crowd lending is what modern banks don't want you to understand. The real profits are in lending, not borrowing. Start small. Reinvest often. Watch your interest payments become your quiet second income. Because in the new economy, you don't need to own a bank. You just need to think like one. This is one of the smartest ways to make your money work in the digital era: owning digital assets. You don't need land, property, or a storefront. Just creativity, consistency, and a bit of capital. A digital asset is anything that keeps earning after it's created. It can be a design template, a short ebook, a photo pack, a music track, a Notion dashboard, or even an AI prompt pack. Once uploaded to a platform, it keeps selling 24/7 while you do nothing. Websites like Etsy, Gumroad, Envato, Creative Market, and Patreon allow creators to upload simple digital products that solve small problems for other people. You can start with $50 to $100 to buy the basic tools or licenses, design software, an AI subscription, or a stock library, and turn that into a mini digital business. Let's make it real. Lucia, a 24-year-old designer from Mexico, used Canva to create resume templates. She spent 2 weekends designing and uploaded them to Etsy. Within 6 months, she had earned over $1,800, selling templates at $6 each, completely automated. No ads, no inventory, no shipping. Just one-time work that pays forever. Digital assets also include music or sound effects, stock photography, AI-generated artwork, and even paid newsletters. The goal is to create something once that continues to generate value for others. Even if you don't create, you can invest in digital products by buying licenses or rights to resell them. Some entrepreneurs pay designers or writers on Fiverr to build products for them, then publish under their own brand. It's legal, scalable, and fully remote. Digital assets are the new real estate, but instead of walls and rent, they pay in downloads and subscriptions. The secret? Don't aim for viral. Aim for useful. Solve real problems with simple solutions. Resumes, planners, sounds, code snippets, and your small investment can turn into recurring income that never sleeps. Imagine waking up and seeing money in your account. Not from work, not from selling something, but simply because you own a piece of company. That's the power of dividend investing. When you buy shares of a company that pays dividends, you're not just hoping the price goes up. You're getting a share of their profits, automatically every few months. Companies like Coca-Cola, Apple, McDonald's, and Microsoft have been paying dividends for decades. Some have never missed a payment, even during recessions. Now, here's the best part. You no longer need thousands to invest. Thanks to fractional shares, you can buy small portions of expensive stocks. That means you can invest $10 or $20 into Apple, $50 into McDonald's, or $100 across multiple dividend-paying companies. Platforms like Robinhood, eToro, GBM Plus, and interactive brokers let you automate dividend reinvestment, meaning every time you get paid, that money buys you more shares, which earn you even more dividends next time. This is called the dividend snowball effect. It starts small, maybe a few cents or $1 a month. But over time, as your portfolio grows, those payments can become hundreds or even thousands per year. Let's look at an example. Diego, a 28-year-old from Spain, started with $500 split among 5 dividend stocks: Coca-Cola, Johnson & Johnson, Procter & Gamble, Apple, and Realty Income. He added $50 a month, reinvested his dividends, and within 2 years his portfolio was worth $1,650, producing about $90 per year in passive income. It's not much yet, but it grows on its own, every month, every payment, every reinvestment. Dividend investing isn't flashy. It doesn't make headlines, but it builds freedom brick by brick. And once your money machine starts spinning, it never stops. When your assets start sending you payments, you stop chasing money. That's when you realize you've crossed the line, from working for money to making money work for you. Let's recap everything you've learned. You now know 5 real ways to turn spare money into passive income. No gambling, no luck, just simple, proven systems. High-yield savings and automated funds. Safe, simple, and perfect for beginners. Index funds and ETFs, the long-term engine of real wealth. Crowd lending, earn interest by helping others grow. Digital assets, create once, earn forever. Dividend investing, build your personal money machine. Now, here's the question. Which one should you start with? If you have under $100, go with high-yield savings or micro-investing apps. Build consistency first. If you can invest $200 to $500, move into ETFs or crowd lending. Small risk, better returns. If you're creative or digital, invest that same money into digital assets, templates, products, or licenses that sell passively. And once your foundation feels stable, start dividend investing. It's your bridge to long-term financial independence. The secret isn't picking the perfect method, it's starting. Each of these can become your seed account, growing quietly in the background while you keep learning, improving, and earning more to reinvest. Here's a truth that separates dreamers from doers. People who wait for the right time never start. People who start, even imperfectly, create the time. So take a small step today. Set up your first high-yield account. Buy your first fractional share. Publish your first digital product. It doesn't have to be big. It just has to begin. Because wealth isn't built by luck or intelligence. It's built by repetition. In a few months from now, you'll look back and realize something powerful. You didn't just grow your money. You grew your mindset. In the next video, we'll go even deeper. I'll show you 7 investments that beat inflation in 2026. Where to put your money so it grows faster than prices, taxes, and time itself. Until then, remember, don't save to survive, invest to live.